Hello, and welcome to the Dallas Fed 2023 Texas Economic Outlook featuring Orrenius, Vice President and Senior Economist. I am Roberto Coronel. I'm a Senior Vice President with the Dallas Fed, and I'm honored to be today's moderator for our program. The Texas Economic Outlook is our premier program where we share our economic perspectives and the forecast for regional trends and that drive the economy in Texas. We're very appreciative of you joining us today, and we're excited about the conversation we're going to have with Pia. But we want to thank everyone for the flexibility and understanding as we had to make the difficult decision to shift our program from a hybrid event to a fully virtual, given the weather conditions that we've experienced in the DFW area over the last couple of days. We hope that everyone has stayed safe and warm in these trying days. One of the virtues of the pandemic is that allow us the capability of shifting gears and pivoting quickly in situations like this one. And again, we're just thrilled that you're here with us, and we're very excited to have this conversation with Pia and with you all. I know I speak for myself, but I also would like to speak on behalf of my colleagues at the Dallas Fed and share with you that we continue to be very committed to the mandate that the Congress gave us to serve the American people by promoting maximum employment and maintaining stable prices. This is an area that we've spent a lot of time and will continue to spend a lot of time and energy making sure that we do everything we can to support businesses and families in weathering this difficult time. So now, before I introduce Pia, let me just share a couple of housekeeping rules. First, the first portion of the program, Pia is going to provide some remarks in which she's going to talk to us about the Texas economy and what she sees for 2023. And in the second part of the program, you will have an opportunity to ask questions. And if you are interested in asking a question to Pia, please drop your question in the Q&A box in your screen, and we will try to get to as many as we can. Now let me introduce our speaker, Pia Orrenius. She is a Vice President and Senior Economist with the Dallas Fed. She is a labor economist that works on regional economic growth and demographic change. She leads our regional group within our research department and is the executive editor for a flagship publication, Southwest Economy. Her academic research focuses on the labor impacts of immigration and U.S. immigration policy. Pia is affiliated with several academic institutions and serves in the Council of Economic Advisors in Washington, D.C. She holds a PhD in economics from the University of California, Los Angeles, and bachelor's degrees in both economics and Spanish from the University of Illinois, Urbana-Champaign. So with that, Pia, welcome, and the floor is yours.
Thank you, Roberto. Good morning, everyone. And like Roberto said, I'm really sad that y'all can't be here in person today. Many of you had reached out to me and said, oh, look forward to seeing you at the Fed on Friday, but at least we can be together virtually. And so I think that's great. And we can still get your questions. So that's also, I'm looking forward to a really good discussion at the end of my remarks. But let me start by giving you sort of where we see the regional economy this year and what our forecast is for this year. And that's really the purpose of this event. And then we'll get into some more deeper topics in the questions and answers with Roberto here when I'm done. So we're calling this more speed bumps ahead and a slowing regional economy in 2023. And let me give you an overview and explain what I mean. Oh, first, the disclaimer, of course, these are my views, and I don't speak for the Federal Reserve Bank of Dallas or the Federal Reserve System. So the overview is that really signs of slowing are mounting. We saw that last year, and we can see that whether we're looking at employment data, our measures of economic activity, manufacturing new orders in Texas, consumption growth, and particularly housing and lending. But despite the slowing, we obviously see a lot of strengths persisting, nationally, but also in our region. So first and foremost, last year, Texas employment, according to the Dallas Fed measure of Texas employment, we were up 3.5%, which was, faster growth than the nation, which is typical for us. We tend to grow faster than the nation. We saw that energy activity was very robust. That was our strongest sector. And continues to be. The other thing that we saw, which is interesting, and we've seen through the pandemic, is very resilient domestic migration. So we actually saw a pickup in domestic migration during the pandemic, And then last year, we actually saw international migration also increasing after having been very low during 2020 and 2021. So those are things that also contribute to our regional growth. So the big question on everybody's mind looking into 2023 and what it's going to bring us is soft landing or recession. So our forecast, as you'll see as I present it to you, is going to signal below trend growth. So usually we grow about 2%. So we're forecasting less than 2% for the year, but we're not forecasting contraction. And we tried very hard to make sure and ran a number of different models and did some real stress tests on those models. But we really couldn't get the forecast to incorporate a contraction in our region, at least not at this time. But that said, risks to the outlook continue to be on the downside. And then there's a couple of additional considerations that we'll cover at the end of the presentation that also will bolster the chances of a soft Texas landing in particular when we compare sort of our outlook to that of the nation. Great. All right, well, let's start by looking back at 2022 and sort of see where we came from before we look at sort of where we're going. So employment growth was, I mentioned it was strong in my introductory remarks, and it certainly was, and it was faster than the nation, as you can see here. For all industries, they all grew. We really had broad-based job growth in 2022. Energy was our fastest growing sector, both here in Texas and in the nation, so expanding employment at about 13%, followed by leisure and hospitality, professional business services, and manufacturing. So these were all sectors that added jobs at an above average rate last year. I will say, though, that some of the sectors that are growing the fastest are also the ones that have had the hardest time sort of recovering their pre-pandemic level of employment. So energy is still not back to where they were in terms of employment before the pandemic. So they've been trying to hire, and it's been very hard to hire. And I think that's going to be a recurring theme in this presentation, is the difficulty finding workers. When you look at job growth last year, also geographically, so here we're looking at metropolitan areas, major metropolitan areas in Texas. We can see that also geographically, the job growth has been broad and robust. Austin, of course, is our perennial overachiever every year. Austin, almost every year. Austin grows at the fastest rate, really, among these major metros. So 4.2% job growth last year, even although, at the end of last year, they did slow because the high-tech sector hiring is slowing dramatically in the high-tech sector. But nevertheless, for the year as a whole, Austin did extremely well. Followed by Houston. Houston was bolstered last year by strength in the energy sector, which is still a disproportionate presence in Houston. And then, of course, Dallas and Fort Worth here in North Texas, the economy also did very well and added a lot of jobs. We have slightly slower growth along the border, and also I'm showing you Corpus Christi. And I just want to point out that in some cases, especially with these smaller metro areas or these medium-sized cities, sometimes labor shortages can actually be more pronounced than in the large metros. So sometimes this a lower job growth number is not necessarily economic weakness per se, but it's actually, again, difficulty hiring. These areas have a hard time retaining workers, as a lot of workers tend to leave for the larger cities. So I've shown you annual data, but here, bear with me. This is going to get a little technical. I want to show you monthly data for last year because I'm going to talk about slowing. So the first thing I'm going to tell you in this chart here, this is month over month, Texas job growth in the blue bars. So if you look at the blue bars, the point there is as you go through the year last year, we're seeing shorter blue bars, which is lower month on month job growth. So that was happening. The other thing that happened, though, that was quite significant, and I've highlighted it here in sort of the red circle, is benchmark revisions. So the Dallas Fed has always benchmarked the employment data. And basically what that means is we take the payroll survey, which is composed of sampling about 20,000 firms in Texas every month. And we actually match or adjust the growth rate in the payroll survey to the much, much larger quarterly census of employment and wages data, which is administrative data. That's about 95% of all jobs in Texas. When you do this benchmarking, and so you adjust the growth rate in the payroll survey to match that in the much larger QCW data, we actually got really large downward revisions in the second quarter that came as a big surprise. So in the chart, what I've circled is the gray bars, which is the pre-benchmark payroll job growth data, and the blue bars there in the second quarter are the post-benchmark. So what you can see is that, for example, that negative blue bar in June was a result of a very dramatic downward revision in job growth through the benchmarking process. So for the quarter as a whole, we actually ended up revising job growth down from over 6% to under 2% for that quarter. Now, we don't have third quarter and fourth quarter QCW data yet. We cannot benchmark those yet, but we did forecast the benchmarks for the second half of last year in order to generate our forecast for this year, because we are concerned that because revisions were so big in the second quarter, they're going to continue to be large. So you might be asking now, well, what about the US? Was this a Texas thing with these benchmark revisions? Or did this happen in the national data too? And you heard it here first. Yes, it did. So if you look again here at the second quarter, you can see that those moving from the gray bars to the blue bars, that you're moving into negative territory. That is a large downward revision in the national data as well. So that really payroll job growth for last year as a whole is overstated. And that's really the punchline here from the benchmarking exercise and from me taking the time to explain something that's rather technical, but I just, it's important. And the other key is that these benchmark revisions into the national data are not, officially incorporated until, 2024. January 2024 is when the BLS actually rolls in the benchmark that I'm showing you here. So you have advance notice. But nevertheless, labor markets have certainly been resilient. The point being just not quite as rapidly growing as perhaps the initial payroll survey data shows. All right, let's also look at back at 2022, and let's look at some different indicators. So let's look at economic activity and then housing and energy. So for economic activity, here at the Dallas Fed, we use our Texas Business Outlook surveys. So we have a manufacturing survey and a Texas service sector survey, and I'm showing you on this graph the production index and the service sector revenue index. And you can see in both cases, there were very steep declines in activity in the pandemic recession, which was, March and April, early 2020, and then a very robust recovery. So there was a bit of a boom in economic activity in the second half of 2020 and in 2021. But throughout 2022, as you might notice, you see those lines really coming down. And so that's declining growth. It's still positive growth, but it's weaker growth as we went through the year. And December and January actually were significantly weaker for both of these surveys. And they're both sort of trending very close to zero. And since it's a diffusion index, a zero value is basically, flat activity or no growth. So these surveys are signaling a very weak economic activity. The clue that we had that this was coming was that new orders turned down first. So this is new orders in the Texas Manufacturing Outlook survey. You can see that new orders turned negative in June, and then they've been in negative territory now for 8 months. And so not all of that is weak demand. I mean, some of it's weak demand, especially in the construction sector, with the Fed hiking rates, especially, around the second quarter of last year, we saw, an immediate impact on the construction sector. So some of that is weakness in construction, but some of it is not weakness so much as firms and producers rebuilding inventories. So as supply chains were resolving in the first half of last year, we saw that firms were finally able to restock and get their inventories back up. But as that happened, obviously, new orders fell. Okay, what about the consumer? So we don't have a lot of measures of consumer demand or consumption at the state level. But here I'm using the comptroller's sales tax revenue series, and we've adjusted it for inflation. And I just wanted to show you that's sort of consistent with our economic activity indicators in the sense that slowed to near zero growth at the middle of last year. So we're really seeing a response here in consumption growth to sort of the Fed rate hikes and slowing economy overall. What has been the impact of the rate hikes and so forth on the housing industry? Of course, you're going to see any interest rate hikes are going to affect the interest rate sensitive sectors first. This is home sales I'm showing you here. And I'm comparing you the evolution of home sales by different Fed rate hike episodes through recent history here in Texas. And so basically with that red line is our current experience with home sales in our current round of rate hikes. And you can see that we've never seen a decline in home sales to the extent that we're seeing it now, both in terms of magnitude and rapidity or quickness, if you will. It's a very quick, dramatic decline in home sales as a result of the current round of rate hikes that we haven't seen before. Consistent with that picture of slowing demand in the housing market, we're also seeing home prices begin to fall. So here I'm just showing you the MLS housing price data, and I wrote out the declines from the peak. So whether you look at Texas or you look at these major metros, Austin, of course, again, is the standout performer here in terms of price run-up in single-family homes during the pandemic. So Austin home prices are down about 9% from their peak at this point. I think they're still up year on year though. And Austin is seeing the biggest declines, followed by, as you can see here, Dallas and, let's see. Yeah, so that's really Austin and Dallas was where we saw the biggest run-ups, and that's where we're seeing sort of prices come off a little bit. But now, this is no reason to panic. I think we had such large increases in home values during the pandemic that the great majority of homeowners still have a tremendous amount of equity in their homes. So I think probably there is room for continued normalization in this housing market. So I think we don't really have to worry so much about this, except for more maybe write it out. When we talk to bankers, what's happening, again, speaking of the housing industry, in general, loan volumes are declining. This is the Dallas Fed Banking Conditions Survey. The first lending activity that turned down was obviously residential real estate. That's the blue line here, followed by consumer loans, commercial and industrial loans, and commercial real estate. This is to be expected. Some of it is weak demand, but some of it is also tighter credit standards, because not everybody, can get a loan today that would have gotten a loan a year or two ago. We did worry a little bit about loan performance, and we're watching loan performance. So here, my colleague was using the consumer credit panel data. Wenhua D is her name, and she's plotting for me the loan delinquency rates, both for auto loans and for bank issued credit cards. And a nice thing that we did here is look at the low income areas versus high income areas. So of course, delinquency rates are much higher in the low income areas. That's the red line on both of these charts. But I guess the encouraging news is that so far, although, for example, for auto loans, we've seen a slight increase in delinquency rates, we're not even at where we were prior to the pandemic. So they still look relatively healthy if you compare it to before the pandemic, even in the low income regions. And then on the credit cards, a similar story. We're really not seeing, we're not even back to, normal delinquency rates, if you will. That's not saying, that we're not going to get there. Unfortunately, we're obviously moving in the wrong direction here. But so far, things look pretty good, given, again, the size of the rate hikes that we've experienced. Just one slide on commercial real estate. I know a lot of you submitted questions on commercial real estate, and we could probably do a presentation just on that. But I did want to talk a little bit about office markets. I think office markets have had the hardest time in the pandemic, and there really hasn't been any improvement yet. So we saw, of course, multifamily markets and industrial markets were very healthy in the pandemic, and have, there's been a little bit of retrenchment in those markets, but they did very well in the pandemic. Office vacancies or office markets, not so much. And that's because, of course, the pandemic came with the work from home boom. And with the work from home boom, that really led to a decline in the demand for office space. And although office vacancies now are quite high, they're not continuing to rise, but they're also not improving. They're not really coming down. Where we had the biggest increase in office vacancies is in Austin. That's the blue line there on the bottom. Office vacancy rates were very low in Austin, and they've sort of increased a lot. And of course, the reason for that is the high-tech industry has such a presence there, and they also very likely to work from home. So biggest decline in office demand has been in Austin, but it's affecting all of the major metros. I think it's probably not going to get much worse, although there's a lot of challenges here. Probably employers are trying to bring people back, and people are resisting. And so, that's going to take a while to resolve itself. But my guess is employers are going to win out at the end of the day, and we're all going to have to go back to the office. All right, just a little note about energy before we turn to inflation. So on energy, I wanted to show you that drilling activity here in the green line, that's the Texas rig count. That's been trending up with the oil price. The oil price is in blue here. And so, of course, after the initial decline in the oil price, initially during the lockdowns and the pandemic recession, there was a complete cratering of demand for oil products like gasoline, for example. But then there was a rather quick, unexpectedly quick, perhaps, recovery in the demand for oil and gas. And that was, of course, even more pronounced with the invasion of Ukraine by Russia. So with that, we have seen continued increases in the rig count. But the point I want to make here is that it's not as much as we would have expected, say, 5 or 10 years ago. We definitely see that energy production is less price sensitive today than it was 10 years ago. And there's a lot of reasons for that. We can cover some of that in the Q&A. But the point being, we can't expect the same boost from the energy sector today as we would have 10 years ago in Texas. So it's still a large positive for us, but it's not as big of an impact on economic activity as it used to be. Now, that said, one reason that the rig count was kind of slow to rise with the price of oil rising was that now with the fracking, we actually have something called drilled but uncompleted wells that actually energy producers can go back and complete. So what I'm showing you here in the red line is these DUCs, these drilled but uncompleted wells. And you can see that red line really falling during 2021 and 2022. And what that means is this: when the oil price went up, that oil producers went back and completed the wells they had already drilled. And you can do that when you're fracking. So they went back and completed those wells instead of drilling new ones. And so I think when we look at the rig count, we also have to look at the DUC count to understand what's going on with energy activity. Now, the outlook for energy is pretty robust. This year, they don't foresee as much production increase in the Permian as last year, but it's still going to be expected to be at pretty healthy levels. All right, let's briefly talk about prices, and then we'll talk about the forecast. So what happened to prices in Texas in 2022? Here I'm showing you the CPI, and I'm showing you headline CPI in the orange line and core CPI in the blue bars. And the point here is that I'm showing you month over month, and that's why you're seeing pretty low levels of inflation here towards the end of the chart, 4% for core year on year, month over month, and headline CPI, down to 3. So month over month, we see really stark declines in inflation, even in our area where inflation has been running hotter than in the nation. But of course, these are still far above our 2% target. And also, the fact that the core rate is higher than the headline rate is also a little bit of a concern. And that's because some of the low-hanging fruit in terms of resolving the inflation problem, some of the things like raw materials, commodities, housing prices. These things are all coming down at a pretty rapid clip, and that's helping the headline measure. But the core measure is more correlated with wage growth. So what's happening with wage growth? So here I'm showing you the payroll, so that's hourly earnings from the payroll survey in green. And this is year on year wage growth in the payroll survey. In red is the employment cost index for Dallas and Houston. We took an average of those two. And you can see that definitely wage growth has been coming down. You see the payroll growth the wage growth in the payroll survey was extremely high, like almost 10% at the beginning of last year. And so that's down to about 4.7. The ECI came in at 4.3 here in December that for the 12-month change. So we're definitely seeing these wage growth measures come down, but they're still far too high. So hopefully those are going to continue to come down. Of course, this morning we had, if you saw the U.S. the U.S. employment data came out for January, and so that was a very large number. So, so labor markets are not slowing perhaps as fast as the Fed might like. All right, so what's the forecast for 2023 for Texas? It's 1.4% job growth in 2023. Here I'm showing you a line with actual annual job growth, so you can compare, and then we have the forecast towards the end. So we grew 3.5% last year. We expect to grow 1.4% this year. That is consistent with a soft landing for Texas. We're not forecasting recession. And then there's a range around the 1.4. So 1.4 is significantly below our trend growth, which is 2%. So the range here, though, is 0.7 to 2.2. So we're still expecting, you know, we could definitely, might not come in at 1.4. It might be closer to 1 or a little bit below 1, or it can be closer to 2. But that's our range. And again, it is consistent with a soft landing in our region. So that's kind of the good news. Again, the risks to the outlook are to the downside, because when we go into our surveys, our Texas Business Outlook surveys, and we ask what are the primary concerns you know, list your primary concerns for your outlook for this year, they listed, first of all, potential recession and weakening demand. So most businesses are really worried about our national recession, and so which obviously affects our region. That was the primary concern, followed by higher labor costs, which is also the Fed's concern. So tight labor markets, but still people worried about potential recession. It's a little kind of, it's a weird combination. It's not typically what you see. By now, in a typical business cycle, you would be seeing weakness in the labor market. We're not seeing it to a large extent, not yet. When we asked our Texas firms about what's your price and wage growth expectations for this year, I've circled what they told us in December. They're forecasting 5.6% increase on average in wages for this year, and they're forecasting about 4.7% increase in selling prices. So those are pretty high, but I want you to compare those to sort of that dark blue bar next to the gray stripe bar. And so that's sort of where we're coming from last year. So we're still seeing 2 to 3 percentage point declines in inflation, whether we're looking at wages, selling prices, or input prices. So that's sort of the good news. Lastly, a few additional considerations. I wanted to point out a couple of regularities about Texas in recessions, so that you know, to further kind of bolster our forecast and say why we don't think that we're going to have a contraction. So unemployment in Texas in recessions typically rises less than the US. So here I'm plotting recessions back to 1990. And in 3 out of 4 of these, unemployment rate has risen less in Texas than it has in the nation. Why would that happen? Typically happens because we have less labor market regulations. We have more wage flexibility. So we might take a larger wage hit, but our labor markets are more flexible, and they're going to react to any decline in demand by, you know, in other ways besides joblessness. So we would certainly see an increase in unemployment here, but it wouldn't be as large, you know, if this year turns out to be sort of a typical case for us. The other thing that's interesting about labor markets in Texas is that we've already recovered in terms of labor force participation. That recovered much faster in Texas than it did in the US. Compare the blue line here to the red line, and you can see that we bounced back faster. So again, we have a more flexible labor market. We have a more flexible labor force that responds more readily to economic signals, and that's going to help us perform a little bit better in a downturn. The last thing that helps us is that a lot of our increase in our labor force is coming in through migration. So here I'm showing you the net migration, domestic in blue and international in red, as expressed as a rate per 1,000 people population in Texas. And you can see during the pandemic how the domestic migration increased and how it increased again in 2022. And then the interesting thing about the new data from the Census Bureau is that red line really spiked in 2022, and that's the resumption of international migration into our region. So the point here being, because so much of our workforce growth is through migration to the state, if there is a downturn, there would be less migration into the state, and so that's also a shock absorber for us that the nation doesn't have. And so we have this shock absorber. These people will not come in a downturn, and so that's going to put less pressure on unemployment. All right, so let's summarize and get to your questions. So the summary is that the Fed speed bumps are having the intended effect, although again with the caveat of this morning's jobs report perhaps. But in general, looking at the region and really evaluating all the data that I've shared with you today, the speed bumps are working. The signs of slowing are spreading. I showed you the benchmark revisions to the employment data, and those were large and negative through the second quarter. So that suggests to a certain extent that the payroll job growth is overstated for 2022. So we still have a robust labor market. It's just not quite as fast growing as you would think from just looking at the data without taking into account the revisions. The other thing I showed you was that interest rate sensitive sectors are really buckling under the higher rates. And now that weakness is spilling over into the broader economy, as to be expected. Again, though, we have some real strengths going forward into this year. Energy is very strong, labor markets are still robust, and the fundamentals of state growth in this region are really healthy. For the reasons I mentioned, Texas, we believe, is better poised for a soft landing than the nation, perhaps. And while energy is less of a boost than it was in the past, it's still a large positive for us. Migration is pro-cyclical, and so it's going to be that, shock absorber that I mentioned. So last comment then is the Texas economy is forecast to grow more slowly this year and likely below trend, but we're not projecting it to contract. And so that said, risks to the outlook are to the downside. And that's all I had. Thank you so much. I guess it's time for questions.
Thank you. Yes. Would you like to?
I'll make my way over with my broken leg.
So thank you, Pia. That was a wonderful presentation that you covered a lot of ground, and now it's the opportunity to engage in questions from the audience. And I just want to say once again, if you are interested in asking a question of Pia, please submit it in the Q&A box in your screen, and we'll try to get to as many as we can. Want to thank everyone who submitted questions in advance. We literally have pages and pages of questions, and we're going to be tracking the incoming questions as well. So we're going to be juggling with all of that. So we have a lot of ground to cover, Pia. Are we ready to jump in?
We're ready.
Perfect. So, the first question, and you alluded to it a little bit about, either on the surveys or the national level, the big concern right now, it's about inflation. And so the question that was pre-submitted is, what impact does the current inflationary environment have on Texas?
Well, inflation, on households in Texas, it has the same impact as in the nation. And I tell you, actually, our inflation rates have been higher here because we grow faster. So we've actually had higher inflation than the nation on average. Inflation erodes the purchasing power of your paycheck. It's an insidious tax on individuals, especially workers or people on a fixed income. So I think that's why, the Fed is so focused on inflation. This is the highest rates of inflation we've seen since the early 1980s. So it absolutely has to be addressed. And the key about inflation is if it goes on for too long, it's baked into what economists call, inflation expectations.
Mm-hmm.
And then it becomes this self-fulfilling prophecy where people expect inflation, so they demand higher wages, and then they're accommodated, or firms raise prices because they expect input prices to rise. And so that's really what the Fed is looking to avoid, is for this high inflation rate to bleed into inflation expectations and become persistent.
Yeah, thank you. We got quite a bit of questions pre-submitted. There's a couple of them coming in around recession, and you talked a little bit about recession. So the question here is, if there is a U.S. recession, how will Texas be impacted compared to the nation as a whole? And I think at the end of your presentation, you talked about those additional considerations. You talked about, the unemployment rate, the labor force participation, the migration. But if there were to be a U.S. recession, then how would Texas fare in this coming year?
So two things. If there is a U.S. recession, typically when the U.S. goes into recession, we go into recession. That's typically the case, although there have been a couple instances where that did not happen. But we typically follow the nation into recession. Now, the exception to that would be if the U.S. has a very mild recession, then we may not follow, because again, we have this growth premium over the nation, which typically holds even in recession. So we're always growing about a percentage point faster in terms of job growth than the nation. And so if we can hang on to that premium, even if the U.S. turns down, there's a small chance that we won't turn down. Of course, if the U.S. were to go into a deep recession, then the story would be different. We would surely follow.
Okay. There's one question that just came in that talks on the unemployment rate. And the question is, why is Texas unemployment rate above the national rate recently, where historically it's been the other way around?
Yes, good question. So we've struggled with this question. So the person is asking, and I showed you Texas and U.S. unemployment in my chart, but I didn't dwell on the fact that actually in the pandemic recovery, it's been the case that Texas unemployment has been higher than the U.S. And we've gotten the same question from some very important people in the state, so we've been working on it. But I think what we've concluded is that it's really this recovery in the labor force participation rate. So I showed you this very robust recovery. We're back to labor force participation rates that prevailed before the pandemic. And so with this resumption of workforce growth and people coming back into the labor market, something that happened much faster here, we've just had more slack in the labor market. And that's really the explanation that we came up with. And some of that is because, frankly, in this state, we rolled back some of that safety net. Some of the stimulus was reduced in the sense that we ended the unemployment benefits a little bit earlier than other states. So in some sense, people had to go back into the labor market. But then, of course, we have, stronger growth here. And so people have been encouraged. And we've had, just as high wage growth, if not higher than the nation. So we've had that also pulling people back in.
Yeah, thank you. As you alluded to in the presentation, we got quite a bit of questions around real estate. And there's more questions coming in. So what is the outlook? What do you see for real estate? And I don't know if you can break it down to commercial, residential. You talk about office space in your presentation for this year. What do you see there?
So, real estate is an interest rate sensitive sector, and so they're going to be the most impacted by rate hikes. And we're seeing it, certainly it's starting out in the single family home market, as I showed you with this rapid decline in sales. And also with prices having turned, and they're now coming down, and they're coming down at a pretty rapid clip. And at the same time, in terms of new home construction, we still have new homes coming online in the sense that those projects were already planned, and that pipeline takes 9 months to build a home, and so we've still got home deliveries coming really in this first half of this year. So it'll be a while before the pipeline dries up. So there's going to be additional pressure on prices in the single family house market. In terms of apartments and industrial, they've done extremely well during the pandemic. And so rents and occupancy in multifamily went to just unprecedented growth of rent and unprecedented occupancy levels, like to the point where multifamily, almost had too much occupancy. They like to keep a little buffer. But the good thing about that, though, they're cooling. But the good thing is that, it's a pretty fast response rate. So we're already seeing rent come down on new leases. So if you look at new leases, you'll see that rent growth has come down. In fact, rents are coming down. So they're responding also to some of the slowing in the economy. And I mean, why is that happening? It's because, frankly, rents went really high, and inflation has been high overall. And so people, what do they do when that happens? Well, instead of living by themselves, renting an apartment, they might rent with somebody else. They might go back and live with their parents. There's a number of things number of ways in which people respond. And so household formation is probably, slowing as a result of the price pressure on people who are trying to rent. And I talked about office, and I think the recovery in office is going to take a few years. I think there's still a mismatch in the labor market in terms of, if you talk to anyone who's looking for a job, if they're lucky enough to be in an occupation where they can work from home, they always say, I'm looking for a job where I can work from home.
Yeah.
And then as an employer, you're looking for somebody who's going to come to the office. So I think there's a little bit of an impasse there that's going to have to resolve itself before office markets can recover.
Correct. And I remember that a couple of years ago, one of our colleagues did some work around trying to understand, what percentage of the workforce, of the labor force in each of the regions or the state would be able to perform his or her job from home. Would you like to, can you share some of that? I mean, where do we stand from that perspective today as far as how resilient was Texas during the pandemic because the capability of people being able to work from home?
Yeah, I have to say, I'm not sure we were right in our predictions. We looked at the composition of the Texas labor market, and we said that there would be less ability to work from home in Texas than the nation on average. Okay. I'm not sure that was borne out. Certainly some sectors, you're not going to be able to work from home. But then, of course, jobs where before you could not work from home, now you can, just because of innovations and changes in technology and so forth. Yeah. I think at the end of the day, we're probably, compared to the nation, we're probably pretty similar in terms of work from home prevalence. I will say one thing though, there is this, I think it's called a Castle Systems, it's kind of a badge monitoring service where they monitor badge swipes in office buildings and they compare across regions. And our real estate expert, Leila Asani, was telling me the other day that it is true that conditional on being an office worker, you're much more likely to go into work at some point in Texas than you are compared to other large markets in the US. So we do, employers here have a preference, more pronounced perhaps than other regions. And so we are more likely to show up for work in the office when compared with the nation.
Okay, interesting, interesting. So there's a question came in around the agricultural sector. And the question is, what's the contribution of ag to the state's economy? And if you can comment on what sort of impact to the sector, to the ag, because of the drought last year.
Yeah, so last year, it's ag. There's a lot for ag producers and farmers to deal with, and the weather. For us, it might be an inconvenience. We can't all be here together today, but for a farmer, it can be the difference between surviving on your farm or having to sell your farm. So weather for agricultural producers is a whole nother thing. And what we saw last year was obviously a very pronounced drought that was pretty devastating to many crops. We saw very extensive crop failure, cotton and other crops that are big in Texas, crop failure rates of 50, 60, 70%. And then, of course, when the rains came, they came like late August, and so it was too late, for the summer crops. But probably good for things like winter wheat and so forth. But in general, in ag, I mean, we've seen commodity prices come down a little bit, and so that's obviously not favorable for them. And then, of course, they have really dealt with a lot of the increases in the input prices. So the raw materials they need, whether it's fertilizer or feed or those really went up last year and really in the pandemic. And so they've dealt with all those hardships. And then, of course, if you're a poultry producer, you've been dealing with the avian flu. And so they've got a lot on their hands.
Yeah, no, they do, and they do that all year round.
Yes,
that's for sure. So you talked in your presentation about migration into the state, domestic and international, and how for now a number of years been kind of a tailwind for the economy, right? For Texas. What trends do you see in the coming years as far as people and firms coming into Texas? Do you see that trend there? Is that going to accelerate, or what do you expect from that angle?
Yeah, great question. So we've been very lucky in that sense, although I understand that there are some negatives to growth as well. Or population growth. It's not all, it's all not all benefits. But in terms of economic growth, it really is a tailwind, Roberta, as you pointed out. And my concern, and certainly I'm happy about the the influx in the sense of people and companies into what's a very productive economy and a very fast growing economy. And I think it generates a lot of employment and economic opportunity for people, and that's great. My concern is that we are pretty much relying on this in-migration for our growth premium. And we're relying on this in-migration also for certain skill categories. So we have recently done 2 articles at the Dallas Fed, one in Southwest Economy and one in our blog, where we've looked at who's coming into our state. And so you can see we look at, we are disproportionately attracting people with advanced education levels. So whether it's masters and PhDs. And the majority of the growth in the labor force in Texas with master's degrees are all from, the majority of that is from in-migration. So my concern going forward, is twofold. First of all, we also need to educate the people here. And so if you're a Texas resident, what can we do to promote educational attainment here? Because we can't rely on that migration because it may begin to taper off. The other thing is just in terms of the volume of migration, that may also taper off. And that's because demographic trends are aging, retirement of the baby boomers, just a slowing population growth overall in the US as a whole. So the places that we're pulling from, California and New York and other large states, but those places are really aging rapidly. And so this influx of workers that we've seen that really allow us to grow at such a rapid pace and bring us the workers that we need, that could very easily dry up. In fact, my prediction is that's going to, start to dwindle over time. And another reason is that really, if you look at cost of living in Texas, I mean, we're still a little bit below, obviously, like California or New York. But cost of living is rising in Texas in a relative sense. And housing prices, for example, have gone sky high in the pandemic. And so affordability, housing affordability is not what it was.
Okay. And that would put some breaks into how people feel about moving into Texas.
I imagine so.
Yeah. So there's, there were a number of questions around more of the long-term drivers, if you will, of the Texas economy. You alluded a little bit about skill sets and workforce development. So there were a couple of questions that came in around what is the role and how can, what is the impact of higher education in the projections for growth for the state of Texas. And then also, I know that you were involved in the Dallas Fed recently launched a report around community colleges and the role that they play in producing the workforce of tomorrow. So can you share with us what are your thoughts around workforce development and the future of the workforce in Texas?
Absolutely. So we're trying to think outside the box when it comes to education, especially if you think of we have not in Texas met some of those goals that we've set out at a state level in terms of getting enough students and not just into college, but also graduating with either a 2-year credential or with a 4-year diploma. And so we've been we've been wondering what else can be done to sort of beef up educational attainment, maybe not in the traditional sort of bachelor's degree sense, to make it easier, on kids to achieve other credentials that can help them in the labor market. And so we commissioned this community college report, and I learned a lot working on it with the author, Tamar Jacoby, and it was very interesting, twofold, interesting to me. One is that Texas community colleges are different. Maybe that's not surprising. It probably shouldn't be surprising to anyone that we tend to do things differently down here. And Texas community colleges are different, and they're different in a really interesting way. And now the state is talking about reforms to the community college system, which is going to make it even more different. Now, what are these changes that they are considering that would be really helpful? Well, some of them are, if you look at the report, you learn many things. You learn, for example, that Texas community colleges have good partnerships with employers in the region. And so you also learn that community colleges, when they're not preparing students for, to transfer to a 4-year school, they're preparing students to go back into the labor market. So whether it's with, a certificate program or other kind of career and technical education, they're going to be fast-tracked back into the workforce. The other thing that you learn, and I was shocked to hear this, is that really is no financial aid for those workforce or CTE students, not at all, to the extent that there's, Pell Grants and other financial aids and student loans for the more traditional academic students. So the idea, and I think some of this was done during the pandemic in Texas, was money was funneled to these workforce program students, these ones that are in these short credential programs, actually grants and so forth to aid them in paying the cost of those programs, because they're paying out of pocket. So we could do a lot, obviously subsidizing these students to finish these programs. They finish them in 1 to 2 years, and they're back out in the labor force. And if you have the college aligned with the needs of employers in the area, you actually have somebody that's going to get hired right out of school. And so that's really, this is great. It's kind of unexplored territory, I think, in many ways, and very promising.
Yeah, because this is, they are all over the state, and they could be this phenomenal revolving door as far as, people coming in and getting reskilled, retrained, and then go back into the workforce, and those would be aligned with the needs of the local economy, if you will. Yeah,
absolutely. And the thing that people forget is we always talk about a bachelor's degree, and I was talking about master's degrees, and we could talk about PhDs. But what we forget, there's a whole middle tier. There's these skilled blue collar workers, or mid-tier workers, as they're called, where there's lots of jobs and there's lots of employment opportunity, and wages are pretty high.
Correct.
I mean, you can make, depending on whether you're looking at truck drivers or other professions here in these mid-tier skill areas, there are 6-figure jobs available in that middle tier.
Yep. So there were a lot of questions, Pia, that came in so the presentation was about the Texas economy, right? So it's the overall state's economy. But the questions were around, can you elaborate a little bit more when you think about different regions? Can you elaborate a little bit more when you think about rural, urban? Can you elaborate a little bit more when you think about different segments of the state, and how do they feel and experience the economy? I know we have a couple more minutes, and those are loaded questions. I don't know if you have any comments, and I know that people can go into our website, and that there's a lot of information that they can find answers to these questions. But I don't know if you would like to make a few comments. What's under the hood when you think about Texas and the different layers there?
Yeah, absolutely. We have even, you compare our large urban areas, they're all very different. But when you compare urban to rural, there's a whole nother set of issues that arise. And I think there's a lot of challenges in our rural areas. And I think you can start looking at this issue by saying, I can't remember how many counties there are in Texas, and we talk a lot about our population growth and our economic growth, but the population growth, most counties in Texas are actually not growing in terms of population. And so these are more your rural areas. And so they're bleeding people to the larger urban areas. And so that's a real problem in the sense, not just for those areas, but also if you think of all the infrastructure and the crowding and the house price effects and everything else with everyone One nice thing we saw in the pandemic was we saw some resurgence of growth and migration, not just into these large urban areas, but we actually saw people moving into some of these medium-sized metros. Like I remember looking at Wichita Falls and seeing, a big influx during the pandemic into people moving to Wichita Falls. And so one nice side effect of this work from home and the technological innovation would be if people could locate in some of these smaller cities, and benefit those communities, give them life, and at the same time, have a lower cost of living, but still be active in the economy. And so I think that would be, what we can do around the edges, or what policymakers can do is think about ways that might make that easier. And so that would definitely be a good change, I think.
Yeah, very good. Thank you, Pia. I mean, the questions still trickling in, and it's I apologize to those who did not have an opportunity to answer your question. But I want to say thank you, Pia, for your remarks and for the conversation. It was very insightful. And thank you, everyone, for joining us this morning. We hope you find the program today valuable and helpful for what you do for the Texas economy, or for that matter, anywhere else you are in the country. And a couple of items that I want to mention to you. One is the recording of this session and PS slides are going to be available on our website shortly, dallasfed.org. I would encourage you to visit our website. There's a wealth of information, not only in the Texas economy, but in other parts of the work that our economists and our phenomenal team perform day in, day out. And also, you will soon be receiving a survey, and we will please kindly ask you to give us your candid feedback. This feedback is very helpful for us as we continue to shape and form future programs, and we want to make sure that we bring the best that meets your needs. So again, thank you, Pia. Thank you for joining us today. Thank you, everyone, and hope you have a great rest of your day, and I hope you have a wonderful weekend.